Good evening, good afternoon, good morning, wherever you are listening to me. Welcome to another episode of Wealth Building Conference. The program is actually designed for medical professionals to help them, open their eye, educate them on financial education. We used to have this program twice in a week. We have it on Friday. The goal on Friday, we focus mainly on professionals, sales agent. If you are in sales or you want to learn the act of selling, right, you join us every 8 p.m. on Friday. And on Saturday, we actually designed this program for medical professionals and business owners who are looking to grow wealth, uh, you know, uh, uh, grow their wealth, invest wisely, and optimize taxes. So today, I'm going to be your speaker and host, Oludare Fasola. Wherever you are joining, please, I want you to do this for me. Type your name and where you are joining from. All right, type your name and where you are joining from. And if you also, I want you to also help me to share this link to friends, families, colleagues who are actually looking to grow wealth. Not necessarily they don't really need to be a medical professionals, but if you are looking for financial literacy, financial education, share the link with them. Let them join and see the value of financial education. We need to understand one thing, that as much as we are go to university, are quite a lot of certificate, they don't teach us how to grow wealth in university. They don't teach us how to make money in universities. What they teach us is totally different from what is happening when we graduated from the university. And the act of making money is a proper understanding of financial education. I've seen many people, right? They make so much money, but they have little or nothing to show for it at the end of the day, right? The difference between the wealthy people and those that are not wealthy is not because of how much money they make. It is how the mindset about money. What do they do with the money, right? So I want you to please pay attention to this presentation today, because I'm going to be sharing a lot of information as regard how can we build wealth, how can we grow our wealth, especially on the angle of how can you really protect much of what you save from taxes. So once again, Oludare Fashola is my name. I'm going to go ahead and share my presentation. Okay. Uh, if you are just joining, I want you to kindly do me a favor. Type your name and where you are joining from. All right. It's going to be, engaging presentations. I'll be asking questions, and I'll be, you know, like, I really want to know your responses by putting in the chat box. So if I ask questions, please try as much as possible to put that in the chat box so that we can, so that it will be an engaging presentation. I don't just want to talk. Okay. And at the end of the day, I want you to take actions. Many times people attend webinars, they attend seminars, but what happened at the end of the day, a lot of people don't really take action. So please don't let just be normal webinars that people used to watch, right? Take actions immediately after the presentation. So today's topic is going to be centered on why every doctor should stop letting CRA eat their retained earnings. Why every doctor should stop letting CRA eat their retained earnings. All right. So more often than not, I've seen many medical professionals. They have so much money, they make so much money, but at the end, what do they do with their retained earning? So the presentation is going to focus on what are the major problems that medical professionals and business owners face, right? What are retained earnings, right? And how do you optimize, how do you invest your retained earning in such a way that you will save a lot on taxes? So let me put a very strong disclaimer here that this presentation is for informational purposes and only, and does not constitute financial or investment advice. Always consult a licensed professional before making any investment or financial decisions. So let's look at the problem now. Why do I actually, the reason why I put up this presentation is just for these three main reasons, because we want to look at the problem. What actually prompted me to put up these presentations together? Number one, most doctors miss strategic retained earnings management. There's difference between making money from your corporation, right? And how do you now invest your retained earning? Let me put it in a layman language. How do you invest your profit after tax? That's what we call retained earning, right? Your corporation make money, right? Doctor, whatever, professional medical corporations or whatever you can call it, different, depends on the provinces you are and depend on the nomenclature they give to it. So let's say a medical doctor have a medical corporation, right? You make X amount of money. Let's say in a year you make $500,000, you pay salary, you pay gas, whatever expenses at the end of the day. That will be profit before tax, right? Now, when they apply tax, okay, whatever that remain is what we call retained earnings. All right, we call it, many people call it profit, but in a professional way, we call it retained earning, right? Most doctors miss strategic retained earnings management. So there is a strategic way of managing retained earning, which is totally different from the normal way we manage normal profit. Okay, now CRA silently erode wealth through taxes and fee. Bear in mind that everything you make in this country, right, CRA must have their cut. Okay, if you make profit from your corporation, you pay taxes. Your return earning, if it is reinvested, you pay taxes. You buy gas, you pay taxes. You buy grocery, you pay tax. Everything is taxes. Even at there, right, you still pay taxes, right? Two things is very constant in this life. It is in this world, it's tax and debt. In Canada here, and in other developed countries as well. Wherever you're watching me, if you agree, type I agree. That two things is very constant. It is tax and debt, right? Whether you like it or not, you're going to pay tax. You have to give what belongs to Caesar, right? Three, inefficient structure costs thousands annually. So we have different advisors, we have different financial planners, we have insurance advisors, right? So, and we specializes in different areas. So not all the advisors know how to structure these strategies very well. If you don't do it in the right way, you put money on the table, right? Everybody type, do it the right way. Do it the right way. So you must understand that as a medical professionals, as a business owners, there is a way that you need to properly structure the strategies to make sure that you optimize taxes and leave more in your pocket. Now, let's look at what are retained earnings, right? This is the definition. Profit kept in your medical corporations after salaries, expenses, and dividend. Now, if you look at this from this angle, you realize that this is all, that is the profit after all the expenses. Okay, after all the expenses. So what the expenses might not be limited to this one alone. Okay, it might not be limited to this one alone. Any profit whatsoever comes out after you've applied all the expenses on the corporation: gas, telephone, salary, internet, whatever, any expenses related or associated to the end result of making that profit, you must apply it, right? So when you applied it, okay, apply taxes, the remaining, the remaining amount is called retained earning. Now, let's look at the strategic use of retained earning. Number one, investment capital. So you can actually use your retained earning for investment capital. You can use it for emergency funds, right? You can also use it for future practice expansion. So In case you want to expand, you can use your retained earning as well. And equipment purchases, if you want to purchase equipment, to the corporations or whatever, you can also use your retained earning. Now, let's look at CRA taxation trap. And this, I've seen many doctors fall into this, and business professionals, they fall into these traps a lot, right? How different income types are taxed in your corporation? Active business income. Now, depending on your profits, depending on your income, right, the tax bracket to be applied by the CRA, and different countries all over the world. We have different tax regime. We have different tax, brackets, right? Now, business owners, right? If you make money from your corporation, right? At the end of the year, they do apply roughly between 12 to 13%, depends on the tax bracket you fall into, right? So this is 15% tax rate, income from your medical practices operation. So this is your medical corporation. Okay. This is your medical corporation. Everybody type active business income. Active business income. So if you make money from your business income, right, you pay tax, right? We are now looking at what happened to the money before retained earning. What are the tax bracket that is applicable to each money you make as a business owners and medical professionals, right? So bear in mind that you are looking between 12 to 15% of taxes that you pay at the end of the day. Now, let's look at the passive income. If you make 50% or more on passive income, you lose small business deduction. Everybody type SBD. SBD. So depending on the passive income, right, you make, you might continue to lose the small business deductions. And you see, nobody will teach you this. Okay. Your accountant will not teach you this. It is your responsibility to learn and understand how money works. Unfortunately, you are so busy that you hardly look into your finance. There are certain things that your accountant will not do for you. Your accountant cannot grow wealth for you. Your accountant will not begin to sit you down and educate you on different tax that is applicable to your income. It is your responsibility to work with a licensed advisor that understand how to strategically, save a lot of your money from taxes. Okay, 50% tax rate substantially erodes long-term growth potential when retained earnings sit idle, right? So now we are looking at how do you strategically invest your retained earning. Some people just leave the money in their corporation there, right? After the profit, after CRA take their cut, just leave the money there. You are living, you're just like, it's just like you are, let the money just slide out there without compounding. Again, personal dividend, 39% rate. When profits are distributed to you personally, right? Depending on the way you structure your corporation, some do dividend, some do salary, some do combination, right? I'm not an accountant. I'm not here to advise on that. You have to sit down and understand which one really good for me, right? Which one do I really need to use to make sure that I optimize taxes, right? I'm not a tax planner. I'm not a CPA. But the thing is that you must sit down and understand, learn little about taxes so that you will know which tax bracket do I fall into, and if I take money from my corporation, what are the consequences of each of these on my income. See, here's the truth. There are certain things that you need to learn about. Failure to do that, you are going to be leaving money on the table. And this is the reality for so many business professionals and business owners in this country today, right? These are the different tax that can be applicable to your income. If you are taking money If you are getting salary from your corporations, you are falling to high income bracket, your personal income tax is probably about 29, 39, 40%, depending on your in your province, right? So imagine you are paying all of these and you're still going to be paying heavy taxes on your retained earning, right? We need to learn, we need to stop this. Now, why it matters to you as a medical professional and business owner? When your corporation pay over 50% tax on passive income, it directly cuts into your savings, reducing both your retirement money and what you can leave behind. Now, look at this figure here, right? If you make $1 million, if from $1 million kept in your corporation for 15 years, you probably can lose up to $537,000 in taxes. Oh my goodness. Stop leaving money on the table. Everybody, stop leaving money on the table, right? This is why you need to sit down and understand how money works, right? They don't teach you in medical school. They don't teach us in the university, but you need to learn it, right? Now, less retirement money compared to better corporate strategies. So if you are looking into this figure, right? If you manage your money well, right, you realize that it makes you to have more to spend when you retire. And research shows that many medical doctors work late because why? They don't have enough. There is always an income gap when they retired, as opposed to what they have, saved for their retirement. Because of the lifestyle inflation, they are making so much. They are one of the highest paid, so that will give them that chance to, the lifestyle is very, very big. And when they retired, it is very difficult for them to maintain that lifestyle. So what smart doctors do is to project, like, as you are planning, right? You need to work with an advisors that will project how much do I really need when I retire. It is not guesswork. Everybody type not guesswork. It is not a guesswork. It is a strategic planning. And you need an experienced financial stroke insurance advisor that will sit you down and walk you through on how much do you really need, right? Now, smaller estate, less money for your family or practice sales. Now, if you don't manage it well, you will not have enough money to live for your for the family or the sales from your practice. So you need to understand that this is an important matter that you need to focus on. You must plan extremely well to make sure that I have enough money and I don't leave money on the table such a way that my money will just be going to taxes. Right. Now, the means of safe cash. Keeping cash in your corporation might seem safe, but it's actually losing value through inflation, higher taxes rates, and mixed investment opportunity. Everybody type time value of money. Time value of money. You agree with me that your $10 today is not your $10 next year, right? So if you are keeping money, like a lot of people will just put money in their savings account or checking account, it doesn't really make you to be you don't grow wealth. Bank is actually using your money for their own benefit. So what do you need to do? You need to sit down and multiply this money in a more strategic way that will not also, make you to pay more taxes. Anytime you are investing, the question you need to ask yourself is that, what is the tax implication of what I am doing right now? A lot of us are investing, but we don't really know how to invest, right? Some are actually putting their money in just one basket. So you need to ask yourself question, right? Am I really diversified my investment portfolio such a way that it really make me to save a lot of money from taxes and build wealth for me. Right now, inflation erosion, 3 to 4% annual value lost to inflation. You know the rate of inflations in Canada today and in every country. It's killing. So you need to understand that this is one of the biggest killers of wealth, inflation. So you must know, how can I put my money in such a way that it actually match up with the inflation? Inflation will not erode my money. Tax inefficiency, interest income tax at highest rate. Now, there are 3 ways in which you can pay taxes. I've said it earlier in one of my presentations. Pay now, pay later, don't pay at all. Right? So if you put your money on interest income, right? Interest income is, for example, you buy stocks, you buy shares, you buy bonds, right? You buy real estate, right? Once you sell, right, less adjusted cost base, you have to give CRA their own cut, and it is immediately. So if you are investing, right, is my investment actually efficient enough in such a way that I'm not going to be putting so much money on the table? Because it is one thing to invest, but what about the tax implication of the investment? These are the things that you really need to know as a medical professional, as a business owner. Let me repeat this again and again, right? Your accountant cannot grow wealth for you. It is your responsibility to sit down, right, and ask yourself that question. How do I grow wealth? And because of the fact that you are so busy, you left your finance, you don't take care of it. For God's sake, why are you working? You work so hard, but your money is not working hard for you. You have to balance this. Take time to look into your finance. What strategies do I need to use to make sure that I maximize my money? 3, opportunity cost. Capital not working hard enough. If you have money and your money is not, if you are working so hard and your money is not working hard for you, you are not growing wealth. Wealth is built with intention, right? It is not about how much I make, it is how much I can compound tax free. Have you not seen that many people make so much money, 6 figures, at the end of the year, they have nothing to show for it? Now, how do you see this, right? You have so much debt, paying 22% on credit card debt, and yet you are investing and you are getting 8%, 10%. What is the sense in that? You pay that interest that is killing your wealth first before you invest, and you put a lot, at least 4 to 6 months of emergency funds. This is the formula for growing wealth. And it is not that difficult, but because we fail to learn, we don't pay attention to our finance, and we leave it for people that feel, oh, no, they should be, my accountant should be able to do this for me. I'm not saying that your accountant will not help you to look into your books, but it is your duty, your responsibility to sit down and look into your finance. Right. Let's look at the smarter strategies. Leverage your retained earning. Right. Tax efficient vehicles, structure investment that minimize CRA reach. Now, there are investments that, though it's not as if you're not going to pay tax, but it will minimize CRA reach. Now, creditor protection, shield asset from potential lawsuits. If you have a corporation, right, and you don't know how to protect your corporation from lawsuit, just one single lawsuit can consume all your corporation. So you must put a strategic plan in place to make sure that you shield your corporation. And this is a way, one of the ways to make sure that you strategically invest your retained earning, growth optimizations, maximize returns while minimizing tax burden. Now, when you are growing wealth, right, the biggest killer of wealth, one of the biggest killer of wealth is taxes. So as you are growing wealth, right, your returns must make sure you must minimize tax burden. Now, if you put your money in an investment, let's say, for example, you buy real estate, okay, you're going to pay capital gain tax. And you know the percentage of that when you look at the money you are making. So if you are planning towards your retirement as a business owner, as a medical professionals, right, you must diversify your portfolio. Everybody say diversification. Diversification. Please send me to type diversification. You must diversify. Now, let's look at the corporate-owned life insurance, COLI. Now, tax-free growth, investment growth without annual taxation. So we're going to be looking at these strategies for tax minimization, but we are going there so that I can be taking you through step by step, right? Everybody type COLI, corporate-owned life insurance. One of the very important benefits of this is that tax-free growth, investment growth grows without annual taxation, creditor protections, asset shelter from business risk. So now, there are a lot of times that we invest and it is exposed to creditors, right? This is one of the way in which you can protect your asset. This is creditor proof. Now, legacy planning, tax advantage, wealth transfer. People invest, right? But it is, you now look at the end of the day, they have nothing to transfer to their family. You must have strategies in place to make sure that when you pass, your family don't struggle financially. And you must work with an experienced financial stroke insurance advisor. Everybody type legacy planning. Legacy planning. If you want to grow wealth, you must consider legacy planning. You must. It's a must. All right. Now, let's go. The power of immediate finance arrangement. Everybody type IFA. IFA. Immediate finance arrangement. Now, so you use your retained earning to fund policy. Now, when you want to structure this, and that's what I'm saying, right? Not every advisors understand how to structure this properly. And you need to work with an experienced advisors to help you to structure this properly. Okay. Now, you use your retained earning to fund the COLI. Now, don't forget that this is your corporation. Okay. This is your corporation. All right. Your retained earning is coming from your corporation, right? It has to go to the holding company. Okay. So you set up the IFA on the holding company, not on your corporation. If you want to ask me why, it is because of this number one, it is creditor proof. It also protects your legacy. Now, the corporation itself is a legal entity that can be sued and be sued, right? Now, you want to separate your retained earning from the corporation. So you now set up your IFA on the holding company, not on the corporation. A lot of advisors make the mistakes of setting it up on the corporation. You can do that, but the best way to do it is to structure it on your holding company. Now, you collateralize policy for immediate capital access. So once you structure it on your holding company, right? There's an arrangement in which you now collateralize the cash value, right? Now, there are various ways in which you can structure this in such a way that you have access, right, to your immediate, the money you put in, you can access it depending on the way they structure it, depending on the lending institutions. Though this might not work for everybody. So let me be very clear about this. Everybody type bank loan. This might not work for everybody. So if you want to know how this works for your own case, you need to book a free consultation session with your advisor. If you want to book it with me, that's fine. I'm ready to walk you through free without any charge. Okay. Then tax deduction, interest often deductible against income, depending on the structure, right? I'm saying this and again, depending on the structure, you can also claim tax deductible on that interest. All right. And now reinvest, you deploy capital while policy growth tax free. Let me give you an example of how this strategy works and how it makes sense. Let's say, for example, you want to go into a big commercial real estate, okay? And maybe at the end of the year, you have about $250,000 on your retained earnings, right? Now you pull the money out from the retained earning, you invest that money, you put the money through the holding company. Don't forget that the holding company does not have any operation. So the profit from the corporation is going to the holding company, right? So the holding company right now, they set up the IFA on the holding company. Let's say, for example, you want to go into real estate and you have maybe $250,000, $100,000, $500,000 you want to use for the down payment. Instead of you to put the money directly on to use it as a down payment, right? You put it on the IFA. Okay, you have done one thing there, right? You have put the money there, the money continue to grow tax deferred, plus you have access to your immediate funds for your real estate, depending on what you really want to do. Okay, every type reinvest. It's a complex strategy and it is not meant for everyone. If you want to learn more, all right, book a free consultation with me. I'm going to walk you through on how it works. Okay, so if you are looking to specialize in high ticket client, these are the things that you need to go and learn. You need to learn it. I'm not saying that you as a medical professional need to learn this because you are busy with your medical practice, but you need to work with an experienced financial stroke insurance advisors that will show you how this strategy works. Now, IFA in action. Now, let's look at, for example, this is Dr. Smith. Dr. Smith, 45 years, invests $250,000 retain earning into COLI, right? Leverage policy has arranged bank loan of $200,000 using policy as collateral. Now, everybody type leverage policy, leveraging. So this is what we call leveraging in insurance, in life insurance, and reinvest. So Dr. Smith now reinvest, deploy borrow funds while policy growth tax free. It's a powerful strategist. It's a powerful strategist that will help you to build wealth. But like I said, it is not meant for everybody. You need to know which one really work for me. If you have any question, you can type it in the chat box. I'm ready to address that immediately after the presentation. Right now, let's go. The tax benefit. Right. Number one, interest deductions. Loan interest potentially tax deductible. This all depends on the way it is structured. Depends on the way it is set up. Right. Interest, you can actually deduct the interest. Right? Everybody type interest deductions. So depending on the way it is structured, you can actually deduct the interest. No passive taxes. Avoid punitive passive investment taxes. Now, don't forget, when we are talking about the passive income, right? When you invest, when your corporation make money, right? The profit, which is the retained earning, if it is reinvested, right? Once you make more than $50,000, you start paying, you lose small business deduction and you start paying crazy. You can pay up to 50% on taxes. That is how crazy it is. But you know what? If you understand how money works, right? You avoid all of this, right? And this is something that you as medical professional, you need to sit down with your advisor and ask question. How can I grow this? What do I need to do? Now, enhance CDA. Everybody type CDA. The CDA means capital dividend account. Boost capital dividend account for tax-free distribution. So it all depends on the way it is structured, right? We know some don't really know how to structure this. So that's why you need to work with experienced, professionals to help you to structure it in a proper way, right? There is a way it will be structured that the money, right, will go through the capital dividend account if it is properly structured. Okay, everybody type CDA. 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 Now, how this builds your wealth, all right? How this builds your wealth. Retain earning. Corporate profit redirected from tax exposure. Instead of you to now invest your retained earning directly, okay, and start paying, losing SBD, start paying crazy tax, right? You actually, they will redirect it, will help you to redirect it from the tax exposure. Everybody type tax exposure, tax exposure, tax exposure. So we are talking about retained earnings here, right? There are key things I want you to take home today, even if you don't remember anything. Number one is coding. Number two is retained earning, right? Coding and retained earning. Coding means corporate life insurance, corporate owned life insurance, corporate owned life insurance. So what we are trying to do is to mitigate the risk of the passive income taxes. See, the taxes you pay your corporation is roughly between 12 to 15%, right? If it is passive income, you pay probably about 50%. So it's much crazier when it comes to retained earning. But because you don't have that understanding of how money works, you leave money on the table, right? Many medical professionals, they have a lot of money sitting out in their retained earning. They don't know how to invest it. That is that is crazy. And this money could have been working hard for you while you focus on your medical practice, and this will actually give you an opportunity to retire early. Now, call implementation. Tax shelter growth plus creditor protection. So when it is properly structured, okay, it is tax sheltered, it's also creditor protection. So that's what I said, that for you to get this right, you need to work with experienced professionals to help you to structure it in a right way. Otherwise, you might not really get the way to structure it. I've met some doctors that, when I look at the way it is structured, I just laugh. I say, well, it's just because this is what the specialists understand. This is what you cannot really give what you don't have, right? And if you want to add values to people's life, it is you first add value to your own life first before you add that value to people's life. So if you are not really knowledgeable, experienced about this, it's very difficult for you to do it. Now, IFA arrangement, immediate capital access plus ongoing tax benefit. Still depending on the way it is structured, you can have access to your premium. Like you put money in, you have access to it immediately, depending on the way it is structured. Right. So that's why you need to work with an experienced professionals to show you how, plus ongoing tax benefits. So as you have access to your immediate cash, you're also enjoying tax advantage. Now, result is that protection plus savings plus growth is equal to enhanced legacy. Everybody type legacy. No, everybody in this world want to leave good legacy for their family. But unfortunately, because you don't really have knowledge, you don't have understanding of how it works, you are struggling, right? Be your own bank. Be your own bank. Instead of you to go to the bank, use these strategies to build your own bank. It's possible. Now, Why do you need to act now? Acting now, lock in lower premium, maximize compounding benefit, and optimize taxes advantage while avoiding delay cost. The more you delay, the more it costs you, right? This is more than just insurance. This is a wealth building strategist tools for high net worth individual. It is not designed for just anyhow, individuals, business owners, accountants, lawyers, medical professionals, travel nurses that are making good money, that have corporations, all right, and they have enough money sitting down in their retained earning that they can put into their holding company. This is what they really need. Okay, so it all depends on you taking action immediately. I've seen that in many occasions. You present this to a client and be like, I will think about it. I'll get back to you. And get back to you will never, right? Lower premium today, rate rise with age and health changes. So the more you delay, the more it become more expensive. That is if your insurability is still guaranteed. Because we have some people that want to do this, for some reasons they can't get it, because you need to first be approved for a life insurance. It is actually structured on a life insurance. So the point is that, are you qualified for insurance? Everybody type lower premium, lower premium. So if you lock in the goods, your age, your health, give you opportunity to pay less, more of it will go to investment, more of it will go to cash value, and this will help you to grow wealth quickly. 2, compound advantage. Early action maximizes growth. The more you quickly take actions, the more it is easier for you to maximize growth. So you want to make sure that at least whatever I put in right now, okay, it's not compounding. The power of compounding is in one of the magic formula to build wealth. So the earlier you start, the easier and better for you to quickly compound your money. Higher cost later. Delay increase lifetime cost. The more you delay, the more it costs you. I've seen many times people delay, and for some reasons they cannot qualify it again. Why? Because life happens. Critical illness can strike at any time, and once it happens, you can't get it anymore. So locking the age, locking your insurability. Now, strategic timing, capture tax planning advantage. Now, this is one of the very powerful tools to save on taxes, right? Make sure you do it in a timely manner. Don't delay. The more you delay, the more it costs you. So take action. Now, next step. Now, so you book a strategy session, complimentary consultation to assess potential. Like, there are so many things that is involved. Not only your there are so many things. Your financial report, you have to look at your financial statements, your assets and liability, the ratio of assets to your liability. Look at your the cash flow statement. Look at your income and expenses. There are so many documents that need to be reviewed. So, but like, I cannot be mentioning everything here. So you need to book a consultation call to assess your readiness, to know whether you are even qualified, because not everybody qualify for this strategy. Okay, it is not for everybody. Not everybody qualify for it. Now, evaluate specific benefit for your situations. You need to look at, does it really meet my financial goals? Because there's one thing to say, well, I need this. Okay, there is another thing that you need it, it's okay, but does this really align with your financial goal, right? What exactly are you looking to achieve? What is the purpose of setting these strategies up? You need to understand and answer that question very well before you go into it, because you cannot start and maybe like a year or 2 years down the line you feel that, oh, this is not good for me, or I don't have enough cash flow to back it up. Now, because it is not something that you start today and say, well, maybe by next year I want to stop. No. And that is why it takes time for the uh uh it takes time before they approve it. They have to look at so many things. They have to look at your financial statement for it. They have to analyze it. They have to make sure that they analyze every number to know that, oh, this person really have the ability to meet up with the cash flow. So you might really like something. What about the affordability? So you need to know what is your specific situation, your peculiar situations, and how can I really apply this to my own situation? If it's really meet my situations that I can afford it and it really meet my financial goal, then let's go. Corporate financial review. Analyze current structures and retain any. So you need to look at your current structure. You look at your current situation. Okay. Now, you also need to look at your retained earnings. How much am I making after taxes in my corporation? Right? How much is my profit after tax? 250,000, 300,000, 400,000. How much can I set aside every year? Don't forget that this is not a piecemeal monthly premium, it's a lump sums. If you are putting about 100K in a year, that has to be maybe 10 years pay, 20 years, depending on the structure, depending on who sets it up for you, right? So different financial institutions, they have their different, different conditions. So this might not really apply to everybody. So if you really want to learn more, okay, book a free consultation call with me or with your financial advisor or specialist to walk you through. Okay. And when you are doing that, you also need to seek uh you need to look at this retained earnings, right? Is this something that is going to continue? Because you don't want to make, so when you have, look at your financial report. Is there any growth? If there is growth, will I be able to sustain this? Very key. Implementation. Evaluate strategies with expert guidance. Make sure you seek expert guidance from your accountant, from your financial planner, from your lawyer, because there are some aspects that will have to do with, signing of trust and all of that. It is very key that you carry all these people along for you to be able to set it up in a proper way. But most importantly, you work with an experienced specialist that will handle this for you. And we have a team of specialists that look into this for you with ease. They will set everything for you with no cost. And in you will, by the time you now begin to see, look at your current institutions and look at where you're going to be in about 5 to 10 years from now in building wealth, right? Now, so final thought, it's not how much you earn, it's how much you keep that build wealth. Many people, uh, interpret making so much money to be wealthy. No. Now, see, some people can be making $50,000 in a year and they are building massive wealth. And some people might be making $500,000 in a year. They are not building wealth, right? Money has its own principle. You must follow that principle. Okay? Financial freedom, work because you want to, not because you have to, right? Financial freedom is not is free for those people who are ready to pay the price. Now, secure future. protected asset immune from market volatility. Now, if you are buying stocks, if you are buying shares, these classes of assets are extremely volatile in because of the fluctuation, the market fluctuations, right? So what smart investors do is to apply what we call dollar cost averaging. So when you invest, right, you don't time the market, right? The market is on autopilot. You put your money there and it continues to grow. People panic when markets crash and, well, now I want to sell. No, you can't grow wealth through like that. You must have a strategies and work with experienced professionals that will help you to protect those assets from market volatility. One of the way to also do that is to put your money on index. Okay, instead of putting the money to expose it to the stock market, you put it on index, right? And this is one of the way to really guide against volatility, right? Lasting legacy, maximum wealth transfer to next generation. Maximum wealth transfer to next generation. If you are building wealth and you don't have plan of how can I transfer this to my generation, next generation, you are not really building good wealth. So there must be strategies, right? There must be strategies that will give you an opportunity to transfer the money. Now, last but not least here, schedule your strategy call today, right? Private assessment of your specific situation. We're going to look at your specific situation. Everybody has their own, different way of their situation, right? And it's going to be confidential, right? And we're going to look at immediate value. Now, walk away with actionable insight regardless. So once you book that confidential call, we're going to give you actionable steps that you need to take. Now, just 30 minutes to discover potential savings. So it's not going to be so much time. We're going to just 30 minutes of that. And with no obligation, explore options without a commitment. I want to say thank you for your time today. All right. I just want to say I really want to appreciate everyone for your time today. So if you really want to learn how this works, or you want to book a free consultation call with me, you can scan the QR code, or you are looking to be mentored. Maybe you want to learn about these strategies, or you are struggling with your business and you want to scale, right? You can scan the QR code and reach out to me so that I can really help you. So if you have any, let me just see here in case anybody has any question. Okay. All right. Any question, please? See, like I said, right, this is not a, I'm not here to talk. I'm only sharing my experience and wealth of knowledge that that God gave me, right? So I want you to ask question or engaged me in order for us to learn, because I'm also still learning, right? We are still learning. Okay, so as I'm learning, I also want you to be a blessing to me as well by learning from you. So if you have any question, we can put it there so that we can go through it. So just before we go again, next week I'm still going to talk about another important topic that will touch base a little bit on IFA as well. And it's also on Friday next week as well. I will be talking about closing code. All these strategies are, these are things that many people struggled when it comes to this business. And I really want to share this for free so that people can learn and scale in their business, make 6-figure income in 1 month, 2 months. It's pretty much easy. It is easier to make $1 million in this business than to make $100,000. Why? Because if you focus on high ticket client, all you need to do is to make sure that you are visible, and you gain dominance in your niche. You position yourself and you gain dominance. Once you do that, money will start chasing you, right? Instead of you to chase those clients, they will be the one to chase you. All right. And just a piece of advice: if you are in the business, whatever sells, if you are in the business of sales and you are still like you are serving everybody, you cannot scale. You need to have a niche, right? Make sure as you are going back home today, right? Take your time and ask yourself, who is my ideal client? How can I serve them? And begin look for a mentor that will guide you on how to do that, right? You can't serve everybody. It's going to lead to burnout, right? You must have a way, create your own niche, and don't follow the multitude, right? You sit down, what is my strength, right? It might be your IT professionals, might be immigrant, might be medical professionals, might be business owners, right? Might be non-profit organization. So we have a lot out there that need to be served. So, everybody wants to deal with professionals. So when you are coming from the angle of professionals, right, people like want to deal with you than just talk to just another person. So I want to strongly encourage everyone today that please create your own niche, have your own, position yourself, and begin to add value to yourself. Add value to yourself. Sales can be very sweet if you understand your niche, if you position yourself, if you stop chasing your client and you position yourself in such a way that client will be the one chasing you. All right. So let's try as much as possible to do that. Once again, I want to thank everyone for joining today, right? It has been a very wonderful session. Next week is going to be another time, uh, fully packed session. And I know that we have gained value. If you you know, if you learn today, please help me to type value. Value. If you learn today, just type value. Drop value. If you learn today, type value. You gain. Oh, this is valuable. This is a valuable information. Please type value before we go. If you gain today, please help me to drop in the chat box value. 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 Thank you so much for joining. I want to say I saw some names here. Joel Basco. Thank you so much for joining. I want you to please continue to follow. Let's collaborate and let's see how we can, build our business. Tato need it. Thank you for joining. And okay. Olubola Fashola, thank you for joining. Right. All right. David Bolaji, thank you for joining. Olule Oluyemi, thank you for joining. Type value before we go. Value. Yeah. If you enjoyed today's presentation, drop value, right? And don't forget to share this with your friends, your family. See, what I'm sharing with you today is an information that are giving me an opportunity to close high ticket client, $5,000, $10,000 deal. I'm not joking. So, see, you must know the right word to use when you are in the front of high ticket client. It's not about selling insurance. The business has gone beyond you want to save more money, I want to just buy insurance. Look at the strategy I just shared today, right? It is not just insurance, it's value, like add value to client life. And honestly speaking, they will pay. People have money, they want to invest money, but they don't know. They are looking for trustworthy professionals, individuals that will put their money in a right vehicle, right? So thank you so much once again for joining. See you next week, and God bless. Bye.